Hi guys, welcome back. Now, before we begin, let's take a look at this clip together. It's the last champion of the Olympic diving. So you see that, guys? This is the problem. This is perfect diving with no splash. It is too perfect. This is no splash at all. Just too perfect. Zero splash perpendicular. It's just absolutely perfect diving. That is 90-degree into the water with no splash at all. This is the problem. I just realized is that Chinese are too good at diving, okay? It can fall 10 meters perpendicular, really almost 90-degree straight to the water. This is absolutely insane. Just look at this. I mean, this is the biggest problem we have. Chinese are too good at diving. It is so hard to believe for anyone in the world. I think no one would have imagined this kind of falling. Last time I gave a target for HSI at 19,500. It was on Tuesday, this day, right? So even though I had a low target, I thought it's not gonna do a deep fall with zero rebound. What I imagined would be something like this, you know, rebound a little, consolidate, and then maybe reach a next staircase, which is a normal way of falling for anybody, right? But no, there is no rebound at all. Just straight 90-degree diving. Because it just dropped 3,000 points in just 10 trading days, right? So why not drop another 3,000 in 8 days? Because why not, right? Since we have dropped so fast already, who needs a rebound, right? That's for loser. We would speed it up instead. Ever since the end of January, it was on this day. I remember Thursday. I gave a friendly reminder or warning that maybe Beijing is pausing on all the bad news before the end of Olympic, kind of saving it for after Olympic. I sensed something bad coming, but I didn't know it's that bad. First, on this Friday, it was the crackdown on Meituan to reduce the commission on the platform. And then the next day, it was Tencent, kind of more regulation on the gaming industry. And then the Russian-Ukraine war happened. And then the bombing near the nuclear plants in Ukraine. And then the important strategic meeting over and China announced a plan of GDP 5.5%. And then this we should still have very fresh memory. The SEC pointing out 5 companies for delisting. Next day, the IPO or the second listing for Didi got halted because of the data security issue. And then finally, another kick from JP Morgan, calling all Chinese stocks uninvestable. And not only this, they also have lowered the price target of pretty much every big tech by at least half than the previous price target. So at least one bad news every single day, driving the index down, diving without taking any breath. No rebound at all. For all the international investors, there was no time to take a break, no time to think about the plan, and no time to react. And mostly might end up just being too sick of it, cannot take it anymore, and panic selling. This is exactly what the people manipulating the share price behind want retail investors to do. And this whole falling, I only recall one day of rebound. Last Wednesday when the CPEV had jumped 10%, which I also sent out a reminder on the Discord to remind everyone who grabbed the dip to take profit before closing. And you can see really everything fell much more after that. And yesterday morning I worry people might end up cutting losses before the rebound. So reminded to not panic sell if you did not trim before. Hopefully it had helped some people to avoid panic selling at the bottom. Bottom with the air quote. We don't know where the bottom is right now at this point, but at least do not cut before the rebound. As you see today, we have some good rebound. It continued at the post-market. Many stocks have bottom, or at least show a recent bottom this morning. But the sure thing is, this kind of falling for HSI had never been seen before. The speed of the falling is faster than the financial crisis back in 2008. The valuation had dipped below the level back then. PB ratio on average should be around 0.7 to 0.8, lowest we have ever seen. This is absolutely insane. So right now it is completely useless to take a look at individual stocks because none of them can beat the movement of the market of this kind of Chinese stock selling off. If you're holding any individual companies or growth stocks or tech stocks whatsoever, none of them can survive this crash. That's 100% the case. So it's almost useless to think about their fundamental and wonder why they are still falling even though the valuation is so low. It's useless to separate each individual stocks because they're working as a whole right now. They're crashing as a group. No survivors. The best performer is Yang. YNG, the triple leverage shorting for the Chinese stocks. I've never seen any stocks skyrocketing like this. A month ago, it was trading at 16. Today, the highest was 46, so it got triple in one day. How crazy is that? My God, I've never seen it growing so fast. Last week, I pointed this out on the Discord. When Yang was at 28, that in history, ever since 2012, every time Yang touched the red line, moving average 120 EMA, it is the Chinese stock's bottom. Like March 2020, the COVID crash, the crash in 2018, 2015, 2012. Every time it touches this 120 EMA, it gets rejected and the Chinese stocks would bottom. So last week, I saw it touching. So I expect this to be rejected. And then 1 week later, take a look at this. A super strong breakout like a rocket with insane volume too. It was at 28 and now it's highest at 48. So for sure a breakout. If it can happen to backtest this trend line, it would act as a support and whoever that didn't sell out of the Chinese stock position would take this opportunity as a chance to run away. So it's not looking good. That means the Chinese stocks, HSI, have broken the trend that was formed for 10 years. Because the Yang had no history before 2012. So I don't see how it performed during the financial crisis. So I would say it is looking very bloody right now. This is for sure a crash. It is not a market correction at all. So right now at this point, unless the US market can bottom right away and rebound strongly and shoot up to all-time high again, otherwise I don't see what's the rescue to save the HSI and make it bottom here. It is impossible to predict the movement right now at this point. It is completely irrational sell-off. People just want to run away. So from here on, I would suggest to take every rebound as opportunity to trim the positions, especially the dip we added. Today I bought BABA around 74 because at 73 level was the last support I have for BABA. If this is broken, we are looking back at the historical low at around 57. Lots of room to drop there. So I for sure would set a stop loss at slightly below 73 and would take the opportunity of the rebound to trim on the way up. So right now I will set a first target at 82 and the second target would be within this range between 90 to 100. Take every opportunity to trim first. This is the only strategy, the only way to save our Chinese stocks at this point. to average down at the support and to trim at the resistance to try to lower the cost within the trading range. The sure thing is don't expect it to go back to the moon like 130, 150. Not at this point. This fall, for all the tech stocks or HSI, it's going to take a long time to recover. While we don't know where the bottom is right now, we are experiencing a crash. Let's take it seriously, okay? There's no time to think about regrets or why, the reason. Let's just focus on regrouping, okay? Especially the tech stocks. If you look at Tencent, for example, which is the heaviest weight on the Chinese stocks and HSI, since the IPO back in 2006, it is again this red trend line supporting it every time it dips there. Right now, it's broken. This 2 weeks confirms the broken trend for Tencent. I hope it can stop here, but no one can know the answer right now. No one could have the crystal ball. The good thing is, at least, if we go on the monthly chart, it is stepping exactly on this red trend and seems to have a short-term rebound. For the short term, I do not know how long it can hold and how much it can rebound. The sure thing is right now, a lot of institutions want to cut loss on the Chinese stocks. So the selling pressure is not going to be over, and they would take advantage of the rebound to cut loss. Does that mean Tencent or Chinese stocks is uninvestable for real, like JP Morgan says? Not necessary, but for the temporary, I think a lot of the investors would stay outside, wait on the sideline and see what happened first. Because when the market is irrational, it can be irrational for a while. You cannot expect people to turn from negative to positive in a snap of fingers. It would take time. But the sure thing is, right now, the moving average, 297, it's supporting it. You see, last night it got to the lowest of 297. So at least there is capital buying the dip here, holding this support. Whether this capital or smart money is trying to get in to catch a rebound for the short term or keeping it as a long-term investment, we don't know for now. We will know later. Because these institutions, they can change their mind pretty fast. Whether it is their really efficient research or it is that things are really changing that fast. Because I remember these Wall Street institutions were super bullish on Chinese stocks. They were calling out to buy the dip throughout last year, the end of 2021, like the December sell-off, and again in mid-February. Like January 16, China stock market would bounce back in 2022, but expect green energy, not big tech, to lead the way. Another one also in January, Chinese offshore stocks to turn corner in 2022. China may outperform other markets in 2022. Given its easing cycle has already started, valuations are more reasonable, and there's still low ownership among global investors. On Bloomberg, February 9, signs of optimism emerge for China stocks after state buying. Even mid-February, February 15, China 2022, a year of opportunity. From Seeking Alpha. That was February 15, few days before all the drama. So a few weeks ago, everyone was optimistic about Chinese stocks, and after a few weeks, everyone can't wait to run away. Take every opportunity of slight rebound and just be happy with it and go away. Crazy, huh? Who would have thought? Last year, I also believed Chinese stocks would outperform emerging markets and outperform the US stocks. Part of the strong reason was because of this China Bloomberg Credit Impulse Index. So the Credit Impulse Index is new loan divided by GDP, and it measures the credit cycle in a market. When the economy recovers, the index rises. So that's why you can see that the credit impulse cycle has a strong correlation with the stock market. Like back in 2006, 2008, when the credit cycle bottomed, it was usually the stock market bottom, at least relative bottom, right? Same thing with the 2018. That's why I compare the index movement a lot with the back in 2018. When the US started the trade war with China, it was also in the low credit cycle and bottom at the end of the year, and the stock market bottom and rebound strongly after. This time we are also at the bottom of the credit cycle, at least a relative bottom, at the end of 2021. And after the bottom, we can see that it started to rise. After the bottom, at the end of last year, which is why we also saw a strong rebound, or at least some kind of outperformance. End of last year and beginning of this year, when the US stock was just going through a harder sell-off, we could see the A shares, the HSI were somehow holding much better. Some of the days of redness, we could see that HSI and Shanghai Composite were actually quite green. So I think it has a lot to do with this cycle that we were in, just like it bottomed in 2008 and also the stock market had bottomed. But this time, unlike back in 2008, the credit cycle bottomed and also the stock market bottomed. In 2018, the credit market bottomed and the stock market bottomed. This time, the credit market had rebound showing the bottom, but the stock market is turning the opposite. So there is a huge divergence here. Same thing with what happened back in 2015, the same crash. And usually it has a correlation with the housing price. Here it says China's credit impulse has less to do with the GDP because it usually uses property to stimulate demand when economy downtrends. So new loans are usually backed by real estate. As we know, real estate is one of the main driving engine for the GDP growth. And right now we are experiencing a housing market downtrend. So that's why the credit impulse index is down, the new loans are down. And this is usually indicating the bottom of an economy cycle and the timing for the government to do more quantitative easing, the QE, to pump more money into the market and stimulate economic activities, which is why since the beginning of the year, we saw many times China had come out and announced more stimulus program like lowering the basis point, the consumer stimulus package, doing the exact opposite of the West, like because we know the US is all about reducing QE right now, China is doing the opposite. So many investors thought China would outperform the US market and other emerging markets this year. And what completely changed was the Russia and Ukraine war, because number one, war would make all the money, capital flow from the out of the emerging market into the US market for safety. And second, which is way worse than the first reason, is that China has been recognized as an ally of Russia. So right now the whole world is countering Russia, and investors are afraid that the whole world would be countering China next. And that's why the HSI is falling just like the RSX, the Russian stock index, right? It can just drop 80% in a matter of a few days. And right now, suspended, it's closed. If it's open, you can see way more crashing. And since it's closed, then I guess HSI would take more of the suffer from the selling pressure. And then next we can relate to is the Taiwan index, okay? Which is not falling much better than the HSI. Number one, people associate the Russia-Ukraine war to Taiwan, China. Since the tension is getting bigger and people see what happened with Russia when there's war happening, and they can totally associate it with China and Taiwan. And this is one of the big reasons that triggered the big sell-off. And number two, not to forget that a lot of the emerging market index, like for example, the EEM ETF, the MSCI index, these kind of ETF, they passively buy in the emerging market stocks to track passively, right? And that's why they have a weight on how much percentage to buy for Hong Kong stocks, how much percentage to buy on Taiwan stocks, etc. And now, because HSI and Chinese stocks have dropped so much, so by weight, the other markets like Taiwan index have become too heavy in this emerging market index. And then what happened? And the solution is to passively sell out the Taiwan stocks to balance the index, to balance the portfolio. So next, I think you're probably gonna see more selling pressure for the Taiwan index. Maybe after some rebound, it would keep dipping for more bottom, which might give you a good shorting opportunity on the Taiwanese stock right now to hedge against the loss or the sell-off on the Chinese ones. So right now, the strategy is just to keep buying or average down on the support and trim at the rebound to try to lower the cost. Crazy for baby NIO. Back in December, I said I trim half of my portfolio to keep at least 50% of cash. NIO was sitting at around 30. I said it might dip to 24. Most people did not believe it. And when it got to 24, I said it might dip to 15. Most people did not believe it again. And now, today, it just reached the low of 13. How insane is that? No one would have thought about this. Right now, I look at my chart. All the price have flipped upside down. I thought this, for the price of NIO, around 15, I thought I'm looking at EH. For the price of EH around 8, I thought I'm looking at Luckin. For Xiaopeng to be at 21, I thought I would be looking at NIO back then. So every time I look at the chart, I need to take a moment to realize those stocks have completely different number right now. I have trouble finding them on the chart. This is how crazy these few days are and how much I'm not used to it. For Xiaopeng, the support at 17 should be pretty solid, and the lowest we have gotten to only touch 18.01. So it shows to me that there are some buying volume there to support the share price. First target of the rebound is 22, which we have gotten there, and next is 25. For PDD, I had to keep lowering the target. So you see, last year it had formed a head and shoulder top, and with this measurement you can get, and the measurement you can see from the top to the middle, from the middle to bottom, you can get the target around 22, so 22 to 27 maybe. And we have reached this morning the low of 23. I think the target of the head and shoulder top had been met already. Now let's see if it can stop bleeding from here. First target for the rebound is 30, and second target is around 36, 35. The video is getting long, but you get what I mean by the strategy right now is to buy at the lower support and trim at the resistance. Trade at the trading range to try to lower the cost, and at the same time keep at least 50% cash of the portfolio, like I've always emphasized. So I can't elaborate on every stocks right now, but if you have a stock in your mind that you want me to analyze the support and resistance, leave a comment down below. I would read all of them and mark it down and try to answer the question in the next video, okay? Now, if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.